Today, we're totally exposing the great illusion of modern wealth. We're going to look way past all that surface level flash and really examine the unsexy, completely invisible habits that actually build fortunes. Because, as it turns out, the reality of money is just entirely different from what we've all been conditioned to believe. We look at a guy driving a $100,000 Ferrari and instantly think, wow, that guy is rich. But honestly, the only objective financial truth we know for sure about that driver is that he literally has $100,000 less in his bank account than he did before he bought the car. It's wild, right? It is the great paradox of looking rich versus actually being wealthy.
Take Ronald Reed, for example. This guy was a real-life rural janitor and gas station attendant. He wore scuffed boots, drove a beat-up old car, but when he passed away, he quietly left behind a fortune of over $8 million. No way, right? But then, on the flip side, we have Richard Fuscone, a highly educated, highly connected finance executive with a massive mansion and luxury cars everywhere, and he ended up declaring bankruptcy with absolutely no liquid assets left. This just proves a stunning reality. In the game of money, financial success is basically a soft skill about how you behave. It's completely independent of your formal education or how flashy your lifestyle is. So, to help us totally restructure our understanding of money, we're going to follow this quick roadmap today. First up, the great wealth illusion. Second, minding your own business. Third, the psychology of investing. Fourth, focusing on big wins. And finally, the ultimate hidden luxury. Let's get into it.
Section 1, the great wealth illusion. Looking wealthy versus actually being wealthy. Let's clearly define what we're actually striving for here.
Okay, so there is a very clear, hard dividing line between being rich and being wealthy. Being rich simply means you have a high current income. And that's exactly what fuels the illusion we see every single day. The luxury SUVs, the tailored suits, the whole shebang. But true wealth is practically invisible. It's the unspent financial assets sitting quietly in a portfolio somewhere. It's that incredibly boring, totally unsexy restraint of keeping your money invested rather than blowing it on visible status symbols. Ultimately, wealth gives you options. Being rich, well, that often just gives you debt.
Moving on to Section 2, minding your own business. Assets versus liabilities. Let's see how this ties into the massive difference between what you do for a living and how you actually build your net worth. Look, if your bank account is slowly but steadily growing, you probably already get this hard line between an asset and a liability. It's elegantly simple, really. An asset puts money into your pocket whether you're actively working or not, and a liability, that just takes money right out of your pocket. If we actually want to build wealth, our one and only job is to acquire assets, period. There's this famous interaction that absolutely hits the nail on the head here. Ray Kroc, the guy behind the massive McDonald's empire, famously told a group of university students that he wasn't in the hamburger business at all. Nope, he was in the real estate business. Sure, his profession was selling franchises, but his true business, the thing that actually made him incredibly wealthy, was accumulating all that income-producing real estate sitting right underneath those franchises. Confusing your profession with your actual business is a massive trap. You absolutely must mind your own asset column, not just your employer's. Now, this kind of goes against traditional advice, but treating a massive dream home as your primary investment usually just stuffs your liability column full of mortgages, taxes, insurance, and endless maintenance. It literally drains your cash. When your expenses just rise right along with your salary so you can fund nicer cars and bigger houses, you get completely trapped in the rat race. The quietly wealthy do it differently. They actively choose to keep their housing costs manageable so they can funnel all that excess cash into real income-producing assets. We're talking stocks or investment real estate, the stuff that actually pays you. All right, Section 3, the psychology of investing. Emotional discipline. Because honestly, the math of money is super easy. It's our own emotions that usually ruin us. As humans, we have a deep biological bias toward fear. For example, back in the 1990s, Russian professor Igor Panarin famously predicted that the US would completely collapse by 2010. And you know what? People loved it, because pessimism always sounds so intellectually rigorous and seductive. It kind of lowers our expectations, right? But then, look at Japan in 1945, a nation literally decimated by war that miraculously rebuilt itself into a massive economic powerhouse within a single generation. If someone had optimistically predicted that back in 1945, they would have been laughed right out of the room. Yet it happened. Quiet optimism is the true psychological superpower. It captures the absolute magic of long-term compounding while everybody else is busy panicking. And here's the thing, investing isn't a test of your intellectual horsepower. Not at all. Even Sir Isaac Newton, literally one of the smartest humans to ever walk the earth, fell for this. He correctly spotted a bubble in the South Sea Company and sold his shares early. Smart, right? But then, watching all his friends continue to get insanely rich absolutely broke him emotionally. The FOMO got him. He jumped back in at the absolute peak and lost the modern equivalent of millions of dollars. The lesson here is huge. Financial success demands emotional discipline, not sheer intellect. Embracing perfectly average returns through incredibly boring, low-cost index funds while refusing to chase flashy bets, that is actually an extraordinary behavior. Which brings us to a real game changer, the invisible price of admission. When the market drops 20%, most people totally panic. Why? Because they view that volatility as a fine. They treat it like a speeding ticket, a punishment for doing something wrong that they should have avoided. But the wealthy, they view it as a fee. Think of it like paying admission to Disneyland. The huge crowds and the overpriced food are just the fee you have to pay for the magic of the whole experience. If you can rewire your brain to view terrifying market drops as the necessary admission fee for long-term growth, rather than a punishment, you have mastered an absolutely crucial psychological trick. Moving right along to Section 4, focusing on big wins. Let's ignore the minor details and identify exactly where you should be directing your financial energy every single day. We absolutely love debating minor details, don't we? It makes us feel super productive while totally absolving us from actually taking a real action. It's exactly like people endlessly debating the keto diet versus the paleo diet instead of just, eating a bit less and exercising a bit more. In finance, people will argue forever over a tiny fraction of a percent in a savings account or stress about buying a daily latte. The wealthy just completely ignore those minor details. Instead, they simplify their infrastructure to focus entirely on the big wins. Things like automating their investments, paying down debt aggressively, and actually negotiating to increase their earning potential. And that brings us to the 85% solution. Look, decision paralysis absolutely destroys wealth. Getting started with a decent, automated plan today is infinitely better than doing absolutely nothing just because you're paralyzed trying to research the mathematically perfect portfolio. Executing an 85% optimized plan right now and just letting compounding do all its heavy lifting for you over time is a massive, incredibly unsexy sign of true wealth. Just get started. Finally, Section 5, the ultimate hidden luxury, saving for freedom. Let's look at the absolute most powerful yet totally intangible benefit of quiet wealth. Most people think you absolutely need a reason to save money, a down payment, a new car, a fancy vacation. But let's be real, the world is completely unpredictable. So the ultimate flex? Saving for absolutely no specific reason at all. By building a massive margin of safety, you are creating a permanent hedge against life's incredible ability to surprise you. Think about it. You don't have to take that very first job offer after a layoff. Or maybe you can even choose a lower-paying job just to have a shorter commute and spend more time with your family. Saving blindly is how you literally buy back your own time, your flexibility, and your autonomy. True financial enlightenment requires profound focus. You really have to write down your specific mission. Maybe you're a passive investor just seeking quiet, long-term growth. Whatever it is, define it. And then, you have to ruthlessly ignore the flashy bragging of everyone around you so you can actually stay the course. Taking financial or lifestyle cues from someone who is playing a completely different game than you is incredibly dangerous. Seriously. If you're a 30-year passive investor and you suddenly buy a stock just because some day trader on TV with a 3-hour time horizon screamed about it, you are going to get slaughtered. Or if you go out and lease a pristine new BMW just to match a young corporate lawyer who's playing a super high-stakes status game to make partner, and you're just a remote worker, you are basically throwing your hard-earned money straight into a furnace. So as we wrap up this explainer, I really want to leave you with this one pivotal question to reflect on. Have you defined your game? Are you playing just to look rich to absolute strangers? Or are you playing to quietly build an unbreakable financial system that actually buys back your freedom? I think it's time to stop living for the visual illusion and start mastering the quiet architecture of invisible wealth.